Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm speaking to you from New York City on the 3rd day of September 2019. I do want to remind you I publish a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and you can subscribe to that by going to miningstocks.com. And it is indeed a very exciting time, and I'll be getting to one of the primary stories in my newsletter, and a sponsor of the show will be talking about it briefly in just a minute or two. Also like you to consider signing up for Chen Lin's letter, What is Chen Buying, What is Chen Selling? Go to chenpicks.com to learn about what Chen is up to. He was on our show last week and definitely has some great ideas that you might want to follow. And, of course, Michael Oliver as well, olivermsa.com. Michael will be with me in just a moment. Our sponsors for today's show, Klondike Gold, Novo Resources, Radisson Mining Resources, and Great Bear Resources. And Great Bear is the story of the day, I must say. I'm proud of all of these sponsors. They're all doing very, very well. But Great Bear came out today with some news that is nothing short of phenomenal. The news today points to the possibility of this stock becoming, I think, one of the greatest stock picks in my newsletter since I began publishing in 1981, because each of the press releases that seem to come out that are coming out from Great Bear suggest a higher confidence that something really, a really large grade, a large high grade, and also a disseminated gold deposit is in the making in the Red Lake area of Ontario. The press release is about 4 pages long, but just to give you a flavor of what is embedded in that announcement, here are a couple of the sub-headlines. Great Bear drills multiple gold discoveries along a 3.2-kilometer fault length, the LP fault at Dixie Lake Project. Drilling into a new AutoZone, it's called AutoZone, a 2.6-kilometer step-out from the Bear Rimini, intersects 101 grams of gold over 1.5 meters, within 42 meters, grading 5.28 grams per ton gold, and that's at a depth of only 80 meters from surface. And then another discovery, the Yuma Zone, intersected some 27.77 grams of gold over 2 meters within an 11.08 gram per ton gold intersection. So that is within 11.8 grams of 7 meters of intersection. Well, those of you who heard Eric Coffin talk about Great Bear last week heard him say that if the new Bear Rimini turns out to host a lot of disseminated gold along with the high grades, the ounces on this property, on this project, could start to rise very, very rapidly, and that in turn could bring about some great interest from some of the major miners sooner rather than later. And in today's press release, there was reference to wide intervals of disseminated gold mineralization surrounding and adjacent to the high-grade intercepts. So it looks to me like the big fish could be swimming around Great Bear sooner rather than later. But Great Bear is very conscious of needing to optimize shareholder value. They've kept the number of shares down very low. They are very concerned about not allowing the big boys to come in and gain entry and gain too much dominance in the voting of the stock. I know they're very conscious of that. We will have Chris Taylor, the president of the company, on this show sometime in the near future. But I would just say this, that now is the time. The gold and silver mining stocks are definitely on a tear, and they may be just at the beginning. I believe they are. Time will tell. But there's never been a better time, I think, in many years to start seriously considering investing in junior gold mining shares than right now. Indeed, a couple of weeks ago, Frank Holmes said much the same thing when he was on our show. Well, I've titled today's show, Can the American Empire Survive a Failing Economy? David Stockman, Daniel McAdams, and Michael Oliver are my guests today. The mark of a true prophet is one whose warnings unfold as predicted. Dating back to his days in the Reagan administration, David Stockman avoided political correctness to warn of future doom if America continued to live beyond its means. Stockman's writings have been ignored by elites, but are now starting to come into full view. Rapidly rising gold prices and plunging treasury yields are flashing a dire economic signal, it seems, to many who are observing the connection between gold and some of those other markets. Last week at Jackson Hole, Bank of England President Mark Carney said that the dollar's days are numbered as the world's reserve currency. And out of panic, another former central banker, Bill Dudley, implored Jerome Powell to ensure that President Trump is not reelected, no doubt in part because Dudley is terrified by Trump's trade policies, as are many people on Wall Street, I dare say. There's no question the trade issue causes gloom on the global scene, and it is no doubt leading to declining GDP in various countries, including our own. However, there are deeper reasons for global economic problems. As Alistair McLeod pointed out last week, the U.S. dollar interest rates are being driven lower by money around the world seeking positive yields, which is pushing U.S. dollar interest rates down. Indeed, I did read that something like 93% of all positive yielding investment-grade bonds are trading in the United States, one of the few countries where there's still a dominance of positive yields. As Alistair pointed out, if the world's reserve currency, that is the U.S. dollar, goes into negative rate regime, it will be all over for the dollar as the world's reserve currency. Well, this is certainly one of the issues I want to talk to David Stockman about. We'll get his opinion on what negative rates mean for the economy and for our markets. And David will be with me in the second half of today's show. In just a few minutes, I'll be talking to Daniel McAdams after our first commercial break. He's with the Ron Paul Institute. I want to ask Daniel about some of the geopolitical signs of disharmony that he and Ron Paul are observing, because I think they're also very important. We are in the process of angering a lot of our best allies because we want them to do certain things that are our interests, not necessarily in theirs. And so there's a lot of things to keep an eye on, not the least of which, I think most of all, interest rates. I'm really thankful to tell you, though, that, we've got Michael Oliver with us again, thankfully. He was away last week. Thanks for joining me again, Michael.
Hi, Jay. Good to be back.
Always good to have you with me, and I know our people that listen to this show really feel that way. You suggested to me this morning that probably the most crucial market to keep our eyes on now, the U.S. equity markets in particular, I know you follow the S&P. Help us understand why you think that's so crucial right now.
Well, obviously, as you just said, what's going on with the debt markets, T-bonds, government debt, and gold is very similar. They're going vertical. Okay, why? Mm-hmm. Okay, they're inverse to the S&P, and they have been for a while. And obviously, money's moving out of the stock market, and the stock market, the S&P anyway, has not gone anywhere for a year and a half. Go back to January 2018. Today's low is just about where that price was. So obviously somebody's vacating that asset category, which is the most bloated stock index in the developed market world, is the U.S. market, more so than Europe, even more so than Japan. And they're going into T-bonds and chasing whatever yield is left, and they're going into gold, and now silver, and now platinum, by the way, by our work. Though we stress the gold side of the equation, gold, silver, and gold miners, not platinum. But platinum has now joined in, technically. There's a reason for this. Now, you can debate about it academically and so forth, but it's our view that, we've had a decade of asset price construction by the central bank, the Fed, and the European Central Bank, and the BOJ to drive stock prices up. That was one of their primary objectives. BOJ even bought stocks. They own a chunk of the ETFs over there. We all know this. And the Federal Reserve has for a decade or more entertained ideas, and in fact, it's out there in the real world. You know about it, of the put strategy they have to actually buy stocks and so forth. So it's not a conspiracy theory.
No.
Whether it's being implemented, I don't know, but the point is that they'll go to that desperate step if they need to. And our technical work on the S&P now says that right now we're trading in high 2800s. You can't be trading in the mid 2600s. If you do, our view is a correction will turn into a crash. And we've never seen anything like this in the history of the technicals of long-term momentum of the U.S. stock market. And we've gone back and studied them. In fact, I was in the crash of 87, so I caught that. But we went back even to the 1920s and technically applied our methods. And there's only two times where we've seen structures of this, like the bridge on the River Kwai structure, if you'll imagine that in your mind, something to blow up and have implode. It was in 1987 and 1929. But the one we have now is far wider in terms of the number of years it's been developed. on annual momentum of the S&P. It goes back about a decade. And it's our view, if you get the correction that many major Wall Street firms think is, justified, reasonable, and so forth, it will not turn into a correction. There are triggers below us that should turn the S&P into something on the downside that's very dark, very rapidly.
Oh.
Now, that would fit, if you look at the T-bond chart and the gold chart over the last few months, what in the world are they bothered about with such urgency? Okay, well, the S&P has been sort of complacent. If you look at the price chart, back and forth and back and forth, everybody's asleep, debating the issues and so forth. Maybe they know something. That's my assumption. And so, get off the subject a little bit here, but your next guest, connected to Ron Paul, it's our argument that the people in that hold the view that Trump has this election sewed up because of the economy strong or the stock market strong. That could change like a light switch.
Yeah.
Like a light switch. Yeah. And if that occurs, all the political assumptions out there could be trashed overnight. Which means what? Well, it means some new stuff has to be discounted. What about the possibility of, a socialist being elected, or at least a Democrat, and the House and the Senate go Democrat, go socialist? Would we have to discount the possibility of a U.S. going the European model? That has not been discounted by the stock market, okay?
No.
In other words, what we're arguing is there could be a very dark situation here very rapidly, and we see it in our technicals. That is the technical dynamism, I think, could drive the T-bonds and gold into their next sharp up phase. Is if the S&P crumbles through certain key numbers, and it won't take a lot. So if you're a gold bug, you're long the market, gold market, you're long the T-bonds for the right reasons. You shouldn't be watching those markets as much as you watch the S&P, because we think the S&P is the key ingredient right now.
Okay, that makes a lot of sense. Well, Mike, the thing is that we've got the T-bond now that's under 2%, I believe, right? And how and I know that longer term you've been bearish on bonds and so forth. And last week we heard from our guest Alistair McLeod. He talked about if the U.S. rates go negative as the world's reserve currency, he thinks it's all over for the dollar as the world's reserve currency. That would be something that would fit into some sort of a major change geopolitically and economically, I would think, something of that nature. If the dollar ceases to be, I mean, it changed rapidly. I'm old enough, and I guess you're almost old enough to remember 1971 when we went off the gold standard. That is what set up the problems that we're having right now, in my view. The massive amount of indebtedness, the whole idea of quantitative easing, none of that nonsense could have been possible. The notion that there could be negative interest rates, just absolutely absurd to any rational human being on the face of the earth, and yet that's what these guys are espousing. So I'm just thinking, what you're saying fits, I'm afraid, and not that I want it to happen. Who in their right mind, Michael, wants to see calamity and problems? But these I want to use a polite word, people out of Harvard, Yale, Princeton, all the MIT, the PhDs that sit in the Federal Reserve and have given us this, my goodness, I don't know. I don't know. I just wonder. So do you see then what happens when if the U.S. can the T-bond go into negative rates? What sense would that make?
Our view on the T-bonds is this: that ultimately reality will take over and rates will go up. Okay, but ever since last December, we turned bullish on bonds despite a prior negative view.
Sure,
and they haven't ceased that trend dynamic, and we think there's now more to go. It could be the nature of a spike, where if the S&P does in fact cave, and cave quickly, as we argue certain numbers will generate, then the T-bonds could be in one last exhaustive upward spike where the flight to safety is just enormous. At that point, rates might be near zero or something on that order anyway. However, I don't know if that's sustainable ultimately. In the short run, yeah. Now, the thing, I could see T-bonds and gold, which are in sync right now, divorcing. And I think the point at which the divorce could occur, meaning T-bond prices fall, rates go back up, is after a panic surge into T-bonds based on a panic sell-off in the S&P.
Right.
And at that point, you'll have exhausted the T-bond upside out of sheer fear. And at that point, you could then revert to higher rates. As far as the dollar goes, technically, We are highly suspicious of the rally. It's now 2% higher than it was 13 months ago, using the DXY cash dollar index. So it's not a big move. It's just inching up. And if Trump does exercise his one power that he has without asking for permission from anybody else, and that is to intervene to take the dollar down, he doesn't have to take it down much. A couple percentage points will trigger a lot of momentum breakage. It will induce other people who own the dollar to sell the dollar. So it doesn't require that the Treasury take control, drive it down. All they have to do is topple it just a little bit, and the technicals will take over. And others who are long the dollar will vacate and therefore be sellers of the dollar. And that can shift the balance as well.
Well, and it should shift the balances of a lot of markets we don't even realize right now. It certainly seems a lot of the reason the dollar is strong, and we do have to go to break now, but the reason the dollar is so strong, in part, is there's huge amounts of money coming into the United States looking for investment-grade bonds. And as I just noted, it's something like 93 or 94% of all investment-grade bonds in the world with positive yields are in the United States. So that may be one of the reasons the dollar is being so strong right now. But, of course, gold is rising too, along with, as you pointed out many times, they don't have to be inverse. So we're seeing both gold and the dollars and silver really taking off today. So I don't know. It's a mixed blessing in the sense that those of us who have been positioned in gold and silver are happy about doing well. But at the same time, you see the uncertainty that surrounds all of this is also very unnerving, Michael. But I want to thank you so much. Go ahead.
It's justified. It's a reality that we didn't create.
Yeah, that's correct. That's correct. Yeah. We do have to go. Michael, thank you so much for your wisdom and your ideas. Always good to have you.